Hello, and welcome to this course on fundamentals of financial accounting. So, what comes to your mind when you hear the word accounting? Is it boring, bookkeeping, number crunching, or maybe even, it's not for me? Well, if you earn or spend money, then you already apply accounting in a good measure. Consider this scenario. Michelle is a 19-year-old student. She works part-time, likes to go out for dinner with friends, and often buys new clothes. Now, one morning, Michelle accidentally drops her laptop. Oh no! She will have to get a new one, urgently. She borrows some money from her friend, promising to return it next month. She buys a new laptop from an online computer store. Now, she sits down to prepare her personal monthly budget plan, wherein she lists all her possible cash outflows against income for the month. This will help her plan and take accurate decisions, and it will also help her to fulfill her wishes and commitments. Intuitively, throughout the scenario, Michelle has used financial accounting, and we will explain this in more detail in a moment. But first, let's tell you a little bit more about why financial accounting is relevant. We, as individuals, take many decisions that involve financial transactions, like buying new clothes, going out for dinner, applying for a student loan, or even buying a house or a car. Consciously or instinctively, we consider our budget alternatives before making a decision. Making smart decisions requires information. Accounting provides financial information to make personal economic decisions. Accounting also provides financial information to make business decisions. Good problem-solving and decision-making skills are needed in order to run a successful business. Accounting helps managers solve problems and make decisions. The role of the accounting system is to communicate financial information to the managers. Communication is key. In fact, accounting is often called the language of business. Accountants collect, analyze, and report financial transactions, and then they prepare periodic summary reports to help managers make crucial decisions. Okay, so accounting appears to be vital for business, but is it only relevant for finance professionals? Absolutely not. Imagine tomorrow you became an entrepreneur and a business owner. You want to know how your business is performing. Or, consider this. Your friend has recommended a great stock to buy. You want to learn more about this company before you invest. Or, say you work at a bank as a loan officer. You want to evaluate a company's loan application. Or, imagine you are employed as a government tax auditor, making sure companies pay their fair share of taxes according to the law. As an Internal Revenue Service officer, you wish to determine whether the company has complied with tax laws. All of the above are critical questions. Owners, investors, creditors, and government agencies are considered external stakeholders to the company. The vital information system that assists business owners and external stakeholders in making decisions is called financial accounting. But how? How does accounting present this information? It is primarily through what are called financial statements. Financial statements are a formal summary of a business's financial position at the end of an accounting period, as well as a summary of how it performed from one period of time to the next. The relevant period is usually annually or monthly. There are three main financial statements, what we call the Big Three financials. These are the balance sheet, the income statement, and the statement of cash flows. Before we get into the description of these, let's revisit our Michelle's laptop crash scenario. After buying the new laptop, she is now in a better position to earn monthly revenue from her job. Her laptop is an asset. She also owes money to her friend, which she must repay. This debt is a liability. During the month, She pays money for things like groceries, rent, and new clothes. These outflows are expenses. Are you beginning to see why accounting is the language of business? We've just introduced 4 new terms: revenues, assets, liabilities, and expenses. Keeping this in mind, let's first look at the balance sheet. If you want to know the net worth of the company on a specific date, then balance sheet provides this information. A balance sheet simply lists all the assets and liabilities, along with their accounting values. The total of the assets minus the total of the liabilities is called net worth. Assets are things owned. Liabilities are debts owed. The difference is called net worth. Another name for net worth for a business is called owner's equity. Drawing parallel with Michelle's position, her new laptop is her asset, and the money she owes to her friend is her liability. The difference between the two is Michelle's equity in this case. If the laptop cost $500 and she still owes $300, her net worth is $200. Next is the income statement. This statement measures changes to the net worth from point A to point B in time. It shows a company's increase in assets from selling goods or services, called revenues, and it also shows a company's decrease in assets, called expenses. So, if you need to know the company's financial performance for a specific time period, such as a year, quarter, or month, then the income statement shows this as net income, or net earnings. Revenues less expenses give net income. Hence, in our example, Michelle's part-time earnings for a month is her revenue. Her outflows of cash during the month, on such things as groceries and clothes, are her expenses. The net of these would give us her net income for the period. Another name for income is profit. This is why the income statement is also known as the profit and loss statement. Therefore, an entity's income statement reports on its revenues and expenses, but it does not report all the cash flows of the entity. Remember, Michelle still owes her friend money. When Michelle repays her obligation to her friend, this cash outflow is not a regular monthly operating expense. But since it's a cash outflow, it must be reported somewhere. This brings us to our last statement, the statement of cash flows. This statement merely highlights the sources and uses of cash for a period. Changes in cash are divided into 3 main categories: operating activities, investing activities, and financing activities. So, if we take the beginning of period, balance of cash, and then add net changes from operating activities, investing activities, and financing activities, then we get the end of period cash position. Michelle's borrowed sum would be a part of her inflow of cash from her financing activities. Can you guess under which category would her part-time income feature? Yes, it's in the operating activities. To conclude, accounting is a specialized system of how to manage economic resources, especially cash. The objective of financial accounting is to provide the external stakeholders of a business with the accurate information. It provides this information via the 3 principal financial statements: the balance sheet, the income statement, and the cash flow statement. This ends our first lesson. Thanks for watching.